everyone. We're going to go ahead and get started. Good evening to all my friends joining us from the States and to everyone joining us from Japan. Ohayou gozaimasu. Today we have our whole Mountain Guide team here to discuss our process for acquiring apartment buildings and how we partner with investors to make that happen. First off, a few administrative items. In the interest of everyone's time, I ask that you could please hold questions to the end and we'll open up for Q&A after the presentation. If you have any questions during the presentation, please type them into the chat along with your email address so Erica can get all those together for rapid fire questions and answers at the end. If we don't get to your question, we will email you within the next few days with an answer. And just so everyone's aware, we are recording. Final housekeeping item here. If you could hit the next slide, Erica, we're going to just talk about this disclaimer really quick. Basically, this disclaimer states that nothing in this presentation is a solicitation for investment. This is an educational webinar about our business model and strategies for real estate investing, and we won't be discussing any specific properties that are available for funding. If you are interested in investing after this presentation, we would need to have a further discussion about that. Any returns, analysis, or assumptions we make about the market or investments are just that and should not be taken as guarantees or promises on returns. As with any investment, there lies inherent risk, and we do our best to project and minimize risk with conservative analysis. But like I said, we don't make any guarantees. We are not attorneys or financial advisors or CPAs, and we do not offer advice as such. That's a mouthful. So with that, let's go ahead and jump in. We'll shoot over the next slide. This is what we're going to cover today. A quick little meet the team, and then why invest in real estate, then why apartments specifically, and then we'll shoot over to our process for investing, and then our Mountain Guide strategy. Here's a little meet the team slide. This is all of us here at Mountain Guide. I'll go ahead and go first. My name's Whitney Hayes. Most of you I already know, but I'll give a quick overview anyways. I'm a wife, mother to 3, and now I do real estate investing full time. I got started like many military families do, moving around and buying and selling at most of our assignments. We decided to channel like the love we developed for real estate as we moved around into commercial real estate, and we became limited partners on 224 units in Pennsylvania. And I'm really passionate about helping others build passive income, and out came the idea for Mountain Guide Capital. And now that we have Justin and Erica that's joined alongside, we're here and excited to share our journey with you. With that, I'll turn that over to Erica if you want to go ahead and do your quick intro.
Hey, Erica Thornton here, originally from Montana, Air Force Academy grad, did 10 years of military service in the contracting space, and then was in industry consulting for tech startups the last several years before moving to real estate full time. Been doing real estate for the past 4+ years. We have properties in Texas and Arkansas, and I'm now living in Monterey, California with my husband and 2 children. Thanks. Over to you, Justin.
Thank you. So, hey everyone, I'm Justin Pumper. I'm originally from England and moved to the San Francisco Bay Area in 2011. I've had a passion for real estate since I was a teenager when I used to watch house remodeling shows, and decided back then that this is what I wanted to do when I was older. And now I'm definitely older and making those teenage dreams a reality. My investing journey started in 2016 when I bought my first duplex. I house hacked this property by living in one unit and renting out the other. And that just really opened my eyes to the world of passive income. Since then, I've acquired 26 units, most of which are in Ohio. And I chose Ohio because it's called kind of the golden goose of cash flow and appreciation. Really appreciate you all being here and look forward to sharing some of the knowledge I've gained over the years. Back over to you, Whitney.
Awesome. Thanks, guys. Another person I want to talk about here on the right-hand side in the light blue is Joey Bickham. He is our mentor and our advisor. He's a seasoned real estate investor with a portfolio of over 500 units and $40 million of assets under management. He also hails from our community of military real estate investors with an impressive 19-year career so far as an active duty naval officer. He's a huge asset to our team and our investors with his experience and knowledge. And we're so fortunate to have him and his team's guidance with us on this journey. With that, we'll go to the next slide and talk a little bit about why real estate. I know most of you are here because you've already seen or heard some of the benefits of real estate investing. Maybe you have a home or some properties with equity or a rental, or maybe your portfolio is just traditional stocks and bonds and IRAs and such. Either way, I'm going to hit on some of these few points just to get us on the same page. The first one, and one of the biggest benefits, is the ability to make your real estate investment a passive income producing property. And that's kind of the whole point of this presentation. So I'll just leave it at that because we'll cover that all the way along. The next one would be diversification. This is kind of the hallmark of so many nuggets of investing education, right? It's like diversify, diversify, diversify. Have you ever taken any classes or been, that's everyone's always pointing to that. Yet when many of us were taught that, we were taught that in the context of a stock portfolio, right? Like diversify your stocks, have different stocks or whatever. But real estate is a great asset to diversify your portfolio total outside of the stock market. Another thing is a hedge against inflation. I mean, most of you know inflation's been killing a lot of us lately, and real estate grows along with that, and in most cases outpaces it. So it's a great way to keep up and not get killed by inflation. Finally, just having an investment that's backed by a real asset. I know if I ever look at my stocks, which I try to avoid doing, they're all over the place. You never know sometimes. Well, with real estate, like you have a real tangible asset that holds value, I think a little bit more consistently than stocks and stuff. Let's go to the next slide. Finally, I think one of the biggest things with real estate is you got to look at the returns, right? And we took this data from JP Morgan's annual study of average returns for different asset classes over the last 20 years. And if you can see bonds coming in right under 5%, very low returns. You have the S&P 500 next, which is kind of like your standard index fund and stock market indicator, right? Coming in just under 10. That third one there, you'll see REITs. That stands for Real Estate Investment Trusts. And those are publicly traded real estate stocks. It's the only way you can buy real estate on a public platform like the stock market. And those come in just at 12. The last two that you'll see right there are multifamily real estate assets. I separated them by classes there, and I'll get into that later, like what that means, Class A and Class B and C. But those are kind of the average returns that you see for multifamily apartment complexes coming in between 12 and 17%. So they're definitely providing much better returns on average historically. If you want to hit the next slide, Erica. All right. I forgot to mention in the last slide that real estate has the highest Sharpe ratio score for risk-adjusted returns of any asset class. And I know some of you are wondering, like, what is the Sharpe ratio? The Sharpe ratio is an economic indicator for the returns of an asset class versus the risk involved. And real estate beats every other asset class for risk-adjusted returns across the board. So that's a cool thing, I think, to point out. Right here, let's kind of jump into why apartments specifically, why we like doing apartments. The first one, and the biggest one for apartments specifically, is that they provide economies of scale. And the easiest example of this would say a 20-unit apartment building has one roof, right? Versus a portfolio of 20 single-family homes, which have 20 roofs. Say you have a hailstorm and your roof needs to get replaced. Well, with your 20-unit apartment building, you have one roof that needs replacing versus a slew of single-family homes, you're replacing 20 roofs. That is a prime example of economies of scale. And that goes across the board with everything. Like, it's just more cost efficient when you're investing in apartment buildings. Second, you have forced appreciation. And this happens when we go in and make upgrades to the property. We increase its value because it's nicer, it brings in more rental income. Thirdly would be market appreciation. And we see this in all real estate, right? The markets appreciate properties grow in value just because of growth and inflation. Real estate historically appreciates pretty well. And fourthly, we have cash flow. So cash flow is the profit that the apartment is bringing in, and this is just the rental income from the tenants paying the costs, and then the rest of that is returned as profit to the investors. Fifth, we have principal pay down, which is another benefit. It's basically that our renters are paying down the mortgage and building that equity in that property for us and our investors. And finally, on this one, I know it's a wordy slide, so hang in there with me, but we have tax deductions. This is a huge benefit. The IRS lets us claim depreciation, which means that our property loses value over time as it ages, because it's just it devalues. Even though technically our property is usually appreciating, the IRS lets us claim depreciation, which means that you can take that against your taxable income and it can result in a paper loss, right? So that's awesome. That's a huge benefit for most people. All right, Erica, if you want to go ahead and hit the next slide. All right, so again, going back to passivity, and one of the biggest benefits of apartment buildings is the ability to make it passive. And right here, what we're looking at is kind of comparing apartments to other types of real estate investments, say new build development, or maybe a fix and flip, or maybe a self-managed rental, right? Those all take a lot of time, effort, and work. Anyone who's ever had a rental property knows that it is anything but passive. Anyone who's done a renovation knows that is anything but passive. So with commercial apartment buildings, like, we have the opportunity to work with capital partners as passive investors. And like I said, I'll get into that later, but it's a way to invest in real estate without having to do all the work that you would do with a rental or a fix and flip. All right, another graphic, if you guys can bear with me. This is our process for investing. This is kind of how the money flows and how we partner with investors to purchase these properties. If you'll see on the left-hand side, we have two bubbles. We have the general partners and we have the limited partners at the bottom, right? The limited partners provide the bulk of the capital to fund that purchase. The general partners also provide capital to purchase that, but they operate the property as a business, right? All that capital is provided to the bank, secures a property in the form of a loan. That capital is in the form of a down payment. Property is then operated, right? It produces profit through rental income, and that cash distribution is sent back to the limited partners and the general partners. So this is a really super simplified version of how that partnership works. So regarding profit splits, how are those profits split amongst general partners and limited partners? Usually how we present this is in the form of a 70-30 split, with the bulk of that being returned to the limited partners who are providing the capital for that purchase. The general partners also have some fees. That is what helps kind of fund the endeavor also. Usually we have a 2% acquisition fee, and that's to reimburse the cost of all the effort that goes into finding the property. And then there's also usually an asset management fee of 2% of the monthly income that property is producing, and that's to basically fund the running of that property as a business. So just to be upfront, like, if you ever get and are looking into a deal, to make sure you discuss any fees that come along with that your general partnership team is going to have attached to that deal. All right. Now that we've kind of covered how passive investing works, let's talk about the mountain guide strategy, how we do that here when we're looking at apartments and trying to get those deals going. This kind of walks through our timeline here of how we buy apartments and operate them. First, we focus on finding the deal, and for us, that just means a lot of analysis. We have high expectations, so we sift through a ton of deals. Justin can attest to this. He's probably rolling his eyes because he is like our number guy, and he's going through deals all the time. We use conservative numbers because we never want to overcommit and underdeliver. As an investor myself, I know that I want to have the most realistic idea of what I'm getting into and what kind of returns to expect. So I try to make sure that we're giving our investors that also, so that they know what they can look at receiving. Obviously, like I said earlier, nothing's a promise or a guarantee, but we do want to give everyone an idea of what they can expect. After that, we work on securing funding once we find the deal with our capital partners, so we can move into the third and fourth stages, which is stabilizing and improving the property, which is usually just done by filling vacancies, fixing inefficiencies, upgrading the property. And then we look to exit at about 5 years with a sale or a refinance, so that all our initial returns can be provided back to investors. If you want to hit the next slide, Erica. So one of our first things that we do is market analysis. When we're looking at a location to potentially purchase an investment, we want to do an extensive look to make sure that that's a good place to purchase. First thing we focus on is population growth to make sure it's growing at about 1% a year, with a total increase of about 20% over the last 20 years. And really that's showing us, that this is a healthy city. We don't want to invest in a city that's dying, or losing population. That just wouldn't be good for our investment. Second, we look at median household value. We want to see good growth here because it just lets us know that properties are appreciating in that market, which is obviously something we need to see. Third would be household median income. This tells us a little bit about the folks in this market that will be making up our tenant base. Having people with good income growth is a good economic health indicator and a sign that our tenants will be able to pay their rents. So this is similar to the next metric, which is job growth. Similar there, it's just a good economic health indicator of our tenant base. Finally, we look at crime, because we want to be buying in low crime areas. We want to be purchasing in neighborhoods where people want to live, right? If there's high crime, it's going to be hard to find tenants. We want to make it easy for our tenants. We want to make it a good place where they want to live, somewhere I would want to live. So when we're looking for properties, not only are we looking at location, but we're also looking at types of properties. And this goes into our strategy here. As you can see, we've kind of broken down the different classes within the multifamily apartment asset class itself. And you have Class A, Class B, Class C, Class D. And these kind of separate the types of buildings based on when they were built. You have Class A, which is usually pretty new. It's in upper class areas, has all the amenities. You have Class B, which is a little older, middle class neighborhoods, most of the amenities. And then you have Class C, which is a little bit older than that, maybe 25 to 40 years old. And this will be probably lacking some of the amenities, won't have everything, might need quite a bit of upgrade. And then you have Class D, which are going to be even older than that, needing a lot of upgrade. You're not necessarily going to have a stable tenant base in those areas. So we like to focus on Class B and C. And why is this? Because it is they have the most room for improvement, as opposed to like Class A, where everything's already brand new. There's not a lot of area to add value. But in Class B and C, you do have room to add value and increase your returns. But you don't have the risk that you would have in, let's say, a Class D asset, right, where it's a bit more risky to invest there. You don't always necessarily know what you're going to get. So that's why we focus on Class B and C, because we feel like there's the most room for value add. These are kind of some of the things that we go in and do when we purchase and stabilize and improve those buildings. We obviously do exterior upgrades, interior upgrades. I mean, it's just like signage, parking, paint, floor, all that. We also work on marketing, making sure the property is getting advertised and we're filling those vacancies. We're also looking to save costs, so identifying any inefficiencies and trying to alleviate that. And then obviously increasing the cash flow. And this could just be bringing rents up to market. If they're under market rents, we'll bring those up. Sometimes that's doing utility bill back, where we're just metering each unit so that tenants can be paying their utilities instead of the building, and then upgrading amenities, things like that. All right, Eric, you want to hit the next slide? All right, so if you have been zoning out, I would tune back in for this one. This is one of our last slides and probably the most important one. This is going to be an example of how we would exit a deal. And it kind of goes through the whole timeline of your investment as an investor. If you'll see on that second line there, it says projections. And on this sample deal that I put together, this is a 70-30 split with a 5-year hold. And then you'll see some metrics there, some return metrics. I tried to structure this deal based off of some deals that I've seen in the past couple months. So this isn't a specific deal, but these are some numbers that I have seen lately. I'm not going to say that this is a typical deal because every deal is different, right? Every deal that you look at has different metrics, maybe has different strategies. So I wouldn't say that this is like the standard or anything. These are numbers that I have seen. With that said, like the AAR on this, you'll see right there is coming in at 17% as a projection. The AAR is the average annual return for the investment. And a 17% AAR equals about an equity multiplier of 1.86. And I know you're probably like, oh my gosh, that's so many numbers. Bear with me. I like equity multiplier as a return metric because it's super easy to understand. And I'll put it like this. If you invest $1 and the investment's projecting an equity multiplier of 1.86, then you're looking to walk away with $1.86 at the end. Okay, so almost double, but not quite, is what they're projecting with that. That third metric on there, COC, is cash on cash. And what cash on cash shows, that's going to show not necessarily your return at the end, but what kind of return are you getting throughout the deal, right? How much cash are you getting back throughout the life of the deal? Is it cash flowing well? If something has a low cash on cash, but a high AAR or equity multiplier, it means that most of your returns are coming at the end of the deal, okay? And we know our investors and we know ourselves, we like to have a deal that cash flows off the bat, that we're getting paid throughout the life of the deal. Most people, I think, fall into that boat. Not everyone. Some people are fine with getting paid at the end, and that's okay. But we like to shoot for things that have a cash on cash of at least 8% so that folks are getting cash distributions throughout the life of the deal. All right. With that, we'll go in here. Year one, obviously, is when the investors put in their initial capital funding. And to make this whole thing easier, we'll just say that the limited partner in this instance provides $100,000 in cash commitment to that deal. If they put in $100,000, then that first year, their cash distributions will probably be about $6,000, and that's coming from their portion of the rental income that property is producing. You'll see that the cash distributions for year one are a little bit lower than years 2, 3, and 4. And the reason for that is because usually in the first year, there's a bit more vacancy. Maybe there's some upgrading or renovations happening. So the income's going to be a bit lighter in the first year. For year 2 and 3, that investor seeks to make about $7,000, $8,000, $8,000 respectively for those years. Year 5, we're projecting that investor would make about $9,000 from their portion of the rental income, and then about $48,000 from the proceeds sale when the building sells. Also, their $100,000 would be returned. So to walk it back, they invested $100,000 in the beginning, and at closing, when that deal closes in about 5 years, they would have about 186 total. So that would be an equity multiplier of 1.86. Hopefully that makes sense. If you guys have any questions, let me know. Erica, if you want to hit the next slide. I know that was a lot of information, but before I turn it over to Q&A, there are a few next steps. If you are interested in investing or you have more questions, I would say sit down and define like what your financial goals are. Look at your financial situation. Do you think a passive investment would help you meet your goals. If you are still interested, let's hop on a call and discuss if it could be a good fit. Our contact information is right here, our emails, or you can always reach out on social media and we can schedule a time to get together. With that, thank you guys all for your time. Hopefully that wasn't too painful. I know that was a lot of information. I'll go ahead and open it up to questions. And I have a few that got sent in already. So if I don't have any questions, I can go ahead and start answering some of these. I have someone asked, let's see, how much is an investment? So usually the minimum investment for a passive syndicated deal, which is what we're looking at here for apartment complex, is between $25,000 and $50,000. This depends on the deal, right? Every deal is different, but the Security and Exchange Commission regulations govern how many people we can take on to certain deals. So usually that's set at about 25 to 50,000. Let's see. I've got another question here.
Sorry, Whitney, just add on to that first one. Just to clarify, that's the minimum investment. If you want to invest more than that, feel free. That is just the minimum that is required to meet regulations.
Absolutely. Thanks for that, Justin. Here I have another question. It says, what if I need to pull my money out before the end of the project hits its 5-year mark and closes? Okay, that's a good question. These investments are not liquid. So I recommend folks, if they suspect that they're going to need that capital within the next 5 years, that this probably is not a good strategy for them, because there's not really opportunities for them to pull that back out of this investment. So I'll just leave it at that. It is not a liquid investment. Another one is here, what if I am limited on cash at the moment? So one thing to consider, I know some folks are like, well, I'd like to do this. I don't have like $25,000 hanging around. One option is there are ways, if you have an IRA, to transfer that into a self-directed IRA. And self-directed IRAs allow you to invest in alternative assets like gold, silver, real estate that you typically don't have the option to do on a traditional IRA, which is more like stock market type assets. So that would be something, if you have an IRA, you could consider transferring it over to self-directed, and then you can pick the asset classes that you're going to invest that with.
And just to add to that, Whitney, so both Justin and I invest in real estate syndications with self-directed IRAs, and we'd be happy to talk to you guys about the process there. It's really simple and easy, but it does take a little bit of time to transfer the money over. So it's just a matter of looking at potentially your 401k. How much are you making there? Like, what's your rate of return? If you're going to be making more in a real estate deal, it's worth looking into. And then to go back to the previous question about pulling your cash out, your initial investment is a liquid so that it stays in the deal for the project hold, but your cash distributions every month or quarter are liquid. So you can take those cash distributions and do whatever you want with those.
That's a good point, Erica. I had another question about cash distributions here. Someone asked, how are distributions done? And so I think it's important to note, like, even though rental income comes in monthly for the property, distributions are done quarterly. So if your distributions are $8,000 for that year, you would be looking to get a quarterly check of about $2,000. So those are paid out quarterly, not monthly. Let's see. I think, does anyone else have any questions? Erica, Justin, are you seeing any?
No, chat is all clear at the moment.
Okay, awesome. Well, I think we kept that pretty good. We only hit that at about 30 minutes, which is awesome. Well, I go ahead, and if anybody thinks of anything, please reach out. We are here. Would love to schedule a time that works for you if you have any more questions. With that, I'll go ahead and we'll cut it off. We will see you all shortly. And thanks again for your time.